The last few years, people have been complaining about the cost of living crisis. Don't get me wrong, it's bad. Ridiculous prices for houses, and now car park spaces can cost up to £250,000. But in 2008, whilst we were playing with our baby toys or whatever, our parents were trying to understand what the hell a subprime mortgage bond was. That is what I'm going to try to explain to you today. Disclaimer. I am by no means an economist, far from it. I don't do economics, and it's pretty hard to understand, so I cannot stress this enough. That some of the stuff within this crisis that got publicised, I have no clue what it's on about. So, I'll try and explain things in a simplified way, so that both you and the average Joe can understand. Besides, if you want to look at it from an economics point of view, you would not have clicked on this video, and if you did, then I advise you click off and watch some other video, or film like The Big Short. Or you can stay and watch a guy who still doesn't know the difference between macro and microeconomics explain an economic crash to you, because why not? In 2000, investors were having the time of their life with all the new technology of the late 90s. Investing, then investing some more. Even if they didn't have any money left to invest, they would still invest. But that all went wrong in 2000 with the dot-com bubble. So investors needed to find a new way in the market to invest in. And so, they chose housing. The early 2000s, low interest rates, easy credit, and people buying houses like they were Pokemon cards. Between 2000 and 2006, houses prices surged by 140%. Banks were giving loans out to anyone. You earn $0 a year, have no credit history? Perfect. Here's $500,000. Enjoy your new home. These loans that the banks were giving were called subprime mortgages, aka you're probably not going to pay this back, but here's the money anyway. But before we go any further, I think it's very important that we're on the same page about mortgages. In effect, imagine you want to buy a house. It's $300,000, but you only have $3.47. So you go to the bank and say, hey, can I borrow like all of it? And the bank says, sure, we'll give you the money, but you pay us back slowly over 30 years of interest. That's a mortgage, a big old loan to buy a home. You promise to pay little each month, call your monthly mortgage payment until it's paid off. And if you don't pay, well, the bank can come and take your house away, and this is what's called foreclosure. So, the banks didn't want to hold on to these subprime mortgages, but instead wanted to get rich of them quick. So these banks took thousands of these and bundled them into packages and sold them to investors. These bundles were called mortgage-backed securities, or MBS for short. Wall Street loved these and started to sell them off very quickly. No one knew what was within these securities as they were a clump of mortgages, some excellent and some exceptionally awful. The crazy thing was, they made super bundles with mortgage bundles. Yes, it was as messy as it sounds. These were called CDOs, collateralized debt obligations. Basically, these were filled with garbage loans, but credit agencies stamped on them AAA. Imagine calling a fire child-friendly. If someone said that, you would think they were crazy. These rating agencies basically used that logic and gave extremely risky loans packaging AAA ratings, or AAA ratings. Again, one last pit stop. These AAA ratings are in effect a rating that agencies use to show customers that an investment is extremely safe and has effectively no risk of losing money. So, let's take a scenario. This is Sarah. Sarah wants to buy a house and finds one that looks very nice. But being a smart woman, she checks it with a home inspector. The home inspector looks at the house and gives it an A+ rating. Perfect. So, Sarah buys it, but after a month, the roof starts to leak, rats are in the kitchen, the wiring's apparently ancient. In reality, the home inspector didn't do his job in the first place, and assumed it was all good because everyone was saying it was good. Now, put that into the context of 2007. Credit rating agencies gave bad mortgage investments a perfect score, and investors trusted them, not realizing they were basically buying a financial raccoon den. Now, other people start to enter into the fray. Enter the shadow banking system. These are basically investment firms and hedge funds who did not follow regular bank rules and so started to borrow large amounts of money to buy these bundles, not knowing they were basically standing on a time bomb and it was about to explode. As around 2006 to 2007, house prices started to fall drastically and the people with subprime loans now couldn't make payments. People lost their homes and the amount of foreclosures dramatically increased. It was a crazy time within the US. Now, I know what you're thinking. How come falling house prices caused people not to make payments? Basically, when house prices fell in 2006-2007, many people with risky mortgages owned more than their homes were worth and couldn't afford raising payments. so they couldn't sell, couldn't refinance, and lost their homes to foreclosure. Basically, this created issues within the finance industry, as banks could no longer trust anyone or one another, as no one knew who really held the bad stuff. And then, the big one started to fall. Bear Stearns imploded. Lehman Brothers gone. AIG needed a $180 billion bailout because they insured all this mess. Stock markets tanked. Banks froze. Jobs vanished. And it wasn't just an American thing, it went global. But if you want a video concentrating on that, let me know in the comments below. Throughout the entire world, unemployment soared and trade slowed. So what did the American government do? Well, George Bush went after his term limits, and Barack Obama came into office. His administration introduced TARP, which flooded the US economy with a $700 billion bank rescue to get it back on track. Furthermore, central banks cut interest rates to basically zero. They also introduced quantitative easing and printed money. New laws came to the country too, like the Dodd-Frank Act, which aimed to regulate banks, stop risky betting, and give more protection as a consumer. Was it perfect? No. Did it help? Kind of. So, what caused all this? Let's break it down. Greedy banks, risky lending, bad regulations, overconfident investors, and a complete utter failure of common sense. So, that was the 2008 financial crash. Hopefully you sort of understood it. If you didn't, well, that's the extent of my knowledge. So if you want a better video, go choose another one or rewatch the video. But I hope you enjoyed this video and I look forward to seeing you in the next one. Don't forget to like and subscribe. Thanks for watching.